The headlines around the Chinese economy have been giving cause for concern. The property crisis involving Evergrande is high profile, and this followed the decision by the authorities in China to crack down on tech stocks. What should we read into what's happening? Is China just too big to suffer from any one of these setbacks? Or is there a concern that collectively there is more to come? Welcome to today's IG Trading the Markets podcast. I'm Jeremy Naylor. I'm talking today to technical analyst Ron William from RW Advisory in Hong Kong. Ron looking at some of the fundamentals as well as the technicals around what's happening. Ron, welcome. First, before we get into China specifically, technically, what does a boom-bust cycle typically feel and look like? And can we use what we talk about in this area about what's happening in China at the moment?
Yes, very much, and it's a global roadmap with an asymmetric shape, driven by greed on the upside and fear on the downside. And you can describe it as the mountain climb up and the cliff drop down. And essentially, there's a bear and a bull skew. Now, we seem to be projecting more of a bear risk for Western markets, and vice versa, a bull, super bull cycle opportunity in the years ahead. For Asia. And that's been a signal that was confirmed as part of the great reversal based on economic data and technicals from last year, 2020. But of course, notwithstanding volatility that we're seeing right here, right now.
But that's not how things feel at the moment in China. Yes, I take what you say about Asia. What about growth expectations?
Yes, so ultimately, as we hit the late stage cycle of this roadmap globally, West and East, all markets will be correlated and move in the same direction, but some more than others. And what we're seeing here at the moment in terms of growth expectations, which is an indicator that we look at based on sentiment gauges, that broke down from March 2021 onwards, both in the US and also in China. And so that just shows that two big engines of world growth, certainly China, have been doing so well post-pandemic, but in the end needed to slow down. And as we're seeing right now, that there are rising concerns taking place specifically here in China.
That's a very interesting observation. Let's look at techs in China, where we are technically. Is the drop that we've seen meaningful, or is it just a retracement at the moment?
Yes, so it's at a make or break level technically, and certainly it is meaningful when you combine the technicals with the macro and the policy shifts on the ground. So as many of your viewers will know, the Chinese authorities, just a doorstop away from where I am here in Hong Kong, basically shifted, attempting to do a better balance between maintaining control and allowing for a viable market forces and animal spirits to function within the economy. But basically what some experts are saying that this is a new socio-political and economic shift, which is not likely to be transitory. I know transitory is a buzzword for the inflation debate, but for China policy, this is likely to be here to stay. And so that's been hard on new economic stocks like tech, and that's basically what we've seen in the recent shakeout. Now, to answer your question more specifically in terms of the technicals of the move, yes, they are short-term overstretched based on momentum and sentiment. Sentiment in particular, I'm looking at a survey from Bank of America that shows overcrowded sentiment, number one, long US tech stocks, and we're already seeing FANG stocks being defanged as we speak, long ESG number two, and then short China stocks number three. So it is overcrowded in the short term. However, in the long term, we're likely to see a relative outperformance of value versus growth. And that's the deeper rotation that is taking place, not just in China, but globally.
You did say in a paper you published recently, you were quoted as saying that China was oversold. And the big question is, when you get an oversold situation, I guess this goes back to how we understand things from a technical viewpoint anyway. Can this stay oversold? Or should we expect a positive mood to return because we're oversold? Is this an opportunity to buy back in? Or are you a little bit more hesitant about that? Do you think the oversold situation could prevail for some time to come?
Yes, I think the opportunity has already been taken advantage of by some speculative and more aggressive traders. But right here and now, most are risk averse, and certainly I am too, especially because the volatility really did begin in this negative seasonality period of September, now October, and according to my cycle models, will continue into year end and then 2022 and beyond. So my global cycle models are flashing kind of red signals across the board, and China and Asia in general just basically led that bear situation. We're now seeing some of that effect happening in the US. Just look at many of the overvalued and overbought markets coming off, especially US and growth and tech in particular.
Let's focus in on the tech and take one example that you've called upon for illustration of a company that's fallen from grace, Tencent. This seemed to me, observing the fundamentals, that this was a company that was doing great things for itself and it had the world at its feet at one point. But this is a real fall from grace. What is this drop that we've seen recently in its share price and its move, which was obviously generated by what's happened within the Chinese authorities? What's this telling us about the company itself and the tech sector in general in China?
Well, this is where the macro or the policy on the ground actually does marry up with the technicals. So this is a late cycle reversal that we see here on Tencent, both in terms of the pattern formation, but also a momentum exhaustion signal based on DeMark indicators chiming in all at the same time. And it just suggests that it will truly likely be a poster child mean reversion or contrarian play to the downside. So further risk ahead, and certainly we should be prudent for any of those that still have exposure to the stock. A good time to take profit and maybe manage that position.
Then, of course, we move on to what's happening within China. China is a very big place. There's a lot of people and it has a lot of a budget and so forth. What happens regionally in China? Is there any sort of story of divergences emerging?
Yes, so for investors and traders that are already positioned or they are open-minded to the risk-reward profile of China, either now or generally in the future, it's really important just to be aware of the regional market choices. It's not just the Shanghai Composite, of course. You've got Shenzhen, which is more tech-heavy, along with some of the emerging market stocks across the board. And so expect some mean reversion, underperformance in growth and tech across the board, China and emerging markets. And so that would mean Shenzhen in particular starting to lose some of that allure after 15 years of outperformance, Jeremy. It is now likely to lose some of that momentum. And so the recommendation is to maybe consider new indices like the CSI 300, which is a mixture of the two, better diversification and risk management.
Let's now move on to another area that I mentioned at the top of the interview, and this is the teetering collapse of Evergrande, depending on how you pronounce it. Is this a warning sign? Is it China's Lehman moment, do you think?
Yes, well, it's been called many names: Lehman moment, Bearstone moment, and I think the Volcker moment. And there's really the key point here from a behavioral standpoint is how much does the market care? What is the perception of the market? What are the behavioral implications? And so I think it's really important to spend less time giving it the correct label because, of course, history will repeat in very different ways, as was the case with Lehman. I think what's more important is there going to be a systemic risk moment? And my original label of this entire late cycle phase, Jeremy, if you recall, from last year was the Minsky risk. And that I think is probably a better label to fit not just on China, but just on other black swan events that are taking place right here, right now, which is all on the back of a easy liquidity, late cycle mode, FOMO-led rally, fear of missing out, with a whole lot of super speculative froth. We've seen it across the board, but of course, property is the strongest of them all, and it won't just be Evergrande. There'll be Evergrandes, other ones in China and maybe in other parts of the world that will likely feed through to this. And we're seeing that in the market right now, just in terms of credit spreads, junk bonds rocketing higher. Remember, Evergrande in particular is the most indebted property company, about 300 billion in debt. Junk bonds is $860 billion valuation. That's up 13%. And what's interesting to keep in mind is if you just look at just market dynamics, in addition to the behavioral implications, a China credit signal does actually correlate with global equity returns, even with the neutral currency mix. And we had a spike in China credit in 2020 during the pandemic, which we all remember to be a big risk event. In this VUCA environment, or mixed risk developing as we speak, it's really better to develop scenarios just in case, and as this bear market matures and opens up further risk to the downside.
Just following up on that rising credit risk in China. I mean, so far we've seen Evergrande be what is effectively just a China risk. Yes, we've seen, I think it's UBS and HSBC have said that they've got exposure to some of the bonds. So we do know that there's a couple of banks that do have sort of Western interests that are a part of this problem. But I think broadly speaking, to a lot of people, there seems at the moment at least that Evergrande is a problem that China has to manage itself. This rising credit stress, does that have the potential, do you think, to spill over into other markets around the world with more ferocity? And do you think that we could well get a lot more contagion in the West because of what's happening with this rising credit stress in China?
So yes, the past market dynamics suggests yes. Of course, it depends to what degree the event risk develops over time. At the moment, I mean, so-called experts are suggesting either a full default or partial bailout of some sort. Time will tell, but Evergrande's not the only player here. There are many others, and it's not just China. So I think it's good to not be too sure about the dynamics on the ground, at least mitigate the risk. I mean, certainly those that do have exposure, some of the big banks can maybe digest an Evergrande event to a degree. But I think volatility and credit contagion is a different matter that we should at least prepare for just in case. And certainly as part of the global cycle model that we follow here at RWA, it does suggest Evergrande on or off. This is just part of the cycle, and we're likely to be more risk averse into year end and the new year.
Ron, thanks indeed for joining us. That's today's IG Trading the Markets podcast with Ron William from RWA in Hong Kong. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.